This is level 2 of the CFA program, the topic on corporate issuers, and the reading on cost of capital advanced topics. I'm going to go ahead and start with an example. Some of you might think it's a silly example, but I believe it will resonate with lots of you. This is also the example that I give my students all the time. And remember, these are 20-year-olds. So I say to them, let's suppose that based on all the hard work you're doing in college, you think you deserve a car. And you've picked out a $50,000 car, and the problem is that you have all but $50,000 of those dollars. So I ask my students, I say, where are you going to go to get this money? And they, of course, say, yes, my parents. So I say, let's suppose you go to your mother and say, hey, I need $50,000 to buy a car. What's your mother going to say? And I get all these kind of funny answers. And I say, suppose your mother says, I'll let you have $30,000 and I'm going to charge you 2% interest rate. I'm going to charge you a low percent because, you were such a cute little dude or a little girl and I love you so much, but I still need to teach you the value of money, 2%. So then you go to your father and you say to your father, hey, I need $20,000 to help me buy this car. Will you lend it to me? And your dad says something like, well, you know what? I've got $20,000. I'll let you have it. But do you remember how you used to tease your little sister, and you remember the beer cans I found in the back of your car, et cetera, et cetera. I'm going to charge you 10%. So here's the question. The question is, your mother's charging you 2%, your father's charging you 10%, kind of based on how much they like you. That's kind of a quoted term there. But the question is, what is your cost of borrowing for the total asset? 2% on $30,000, 10% on $20,000, well, you take a weighted average. Now, some of you might think that's a silly example, and maybe it is, but it is a great example in my mind because corporations, we know they don't have moms and dads, but they do have bondholders and shareholders. And the bondholders and shareholders are going to charge the executives an interest rate, not based on how much they like them, but based on risk. And that's pretty much what this reading is, cost of capital advanced topics. How do we conceptualize, how do we quantify that risk element? Your mom and dad just picked 2 and 10% just right out of the air. But bondholders and shareholders are way more sophisticated. And that's what we're going to look at in this particular reading. So we'll start with top down and bottom up. We've talked about that before. And so notice the second and the fourth LOSs. Compare methods to estimate the cost of debt. Compare methods to estimate the required return or the cost of equity. And then at the very end, we're going to go ahead and put this together in two kind of comprehensive examples to look at the firm's capital structure and its cost of capital. So let's go ahead and do just a super brief recap here. So there's the cost of debt, there's the cost of equity. Then you weight those according to the capital structure of the firm, and you get a weighted average cost of capital. One of my professors in graduate school used to call this the weighted average borrowing costs. And that's kind of the term that I use in my classes. But of course, it's a weighted average cost of capital. Remember that this is an interest rate. And it's super important because it's going to be used in several areas. The primary area that we're going to use this weighted average cost of capital is in the capital budgeting process. Of course, we're going to use this number to compute net present value. We're going to use this number as a benchmark when we compute internal rate of return. And of course, this is an important number for bondholders and shareholders and financial analysts out there. So let's go ahead and do differences between top-down and bottom-up factors. So let's do top-down first. So remember, we're starting with kind of the macro economy with top down. So look at that second column in there, market conditions. What does this mean? Market conditions mean things like changes in GDP, inflation, interest rates, energy prices, politics, etc., etc. What the reading emphasizes is that those market conditions can be summarized by credit spreads. So the reading points out that when credit spreads are narrow, combined with low interest rates, then probably the cost of debt and the cost of equity are going to be relatively low. Let's go ahead and skip back to what I missed there in that first row that first column, capital availability, right? More availability of capital leads to a lower cost of capital. This makes perfect sense. Back in my silly example, let's suppose that you not only had a mom and a dad, but you also had 2 sets of grandparents and 4 sets of aunts and uncles and 12 sets of cousins. And all of those people had lots and lots of money. And so you went to them to borrow $50,000 to buy a car. Maybe you'll get not 2 and 10%, maybe you'll get 1 and 7%, right? So more availability of capital. That makes perfect sense. And then, of course, we cannot operate as if we're in a vacuum. There are always other people out there who are interested in what the firm is doing. And when I mean other people, I mean governments and regulatory bodies. All right, so they're legal and regulatory considerations. So think about the political leaders and the laws and the structure of the legal system and the court system, right? If those are stronger, then those are probably going to lead to lower debt and equity costs. And then depending on the tax laws, and we'll talk about this as we go through, but you should remember this from level 1, that many jurisdictions allow the interest expense to show up on the income statement, which then lowers the tax liability. So this favors bond issues, right? So there are greater tax benefits by using debt in the capital structure. So here, I didn't mean to go forward there. So think about this, top-down external factors. We're starting at the top and we're, here are the raindrops or the snowflakes. They're coming down and coming down. And so we evaluate that. I have a colleague, I think I said this to you before. He talks about end scan all the time, scanning the environment. And so that's pretty much what we're doing here with top-down. And then sooner or later, we get to the bottom where we have to evaluate the individual company and the individual bond issue. So with bottom up, we're going to start with company specific factors and then work our way up. So these are just 2 directional methods. Hopefully they lead to the same conclusion. Let's go ahead and move to looking at the specific bond issue and the specific company and moving our way up to the macro economics and the macro environment. All right, so let's look at that first column. Notice it's called volatility. We're talking about revenue volatility, earnings volatility, and cash flow volatility. So what's going to impact the cost of capital? I mean, clearly what we want to do when we see a company and as we observe its revenue, earnings, and cash flow, what we want to have them to have lots of this, right? We want lots of operating cash flow. We want lots of revenue. We want lots of net income. But let's go ahead and ask ourselves the question, what about volatility? So this is super important. Are you ready? So given the fact that a company has sustainable revenue, sustainable earnings, and sustainable cash flow, we need to ask the question, how volatile is it? Some companies have super volatility, some don't. Think of those companies that have brand name product lines. That volatility is probably like this. All right, so let's read this here. Companies with lower revenue, earnings, and cash flow volatility and higher predictability, right? Because they have less volatile in their cash flows, they're going to have high predictability. They'll probably have lower default risk and narrower credit spreads, and this will result in a lower cost of capital. How about the nature of the assets? Remember, on the bottom left-hand side of the balance sheet, we've got long-term assets. And in general, we think of those as being physical assets. But let's suppose that we have physical assets and we have intangible assets. So companies with many tangible assets probably can access the capital markets way more efficiently than those that have lots and lots of intangible assets, mostly because they can be used as collateral. Yeah, that third column over there is exactly what I was saying in the very beginning of this slide. Company with financial strength, lots of profitability, and then in relation to its financial leverage. So let's think about it. On the balance sheet, we've got all the assets over on the left-hand side and then capital structure on the right-hand side. So the firms that have lots and lots of debt, which are probably those firms that have lots and lots of physical assets, they probably have higher default risk and a higher cost of capital. And then we move to this concept of bonds that have embedded options, callable bonds, puttable bonds, convertible bonds. Well, some of these have higher costs of debt, in particular callable bonds. And what they're probably going to do is lead to a higher cost of capital. That makes sense, right? All right, how about the LOS on estimating the cost of debt? I mean, this is super easy that you learned back in the introductory finance course at the undergraduate level. The easiest way to do this is to take a look at the price of a bond, take a look at the time to maturity on the bond, and take a look at the coupon rate, the dollar amount of interest that's being paid to bondholders over the life of the bond. And you can just plug those numbers in your calculator like we did back in level 1, and you come up with a yield to maturity. So that's going to be our cost of debt. But sometimes those inputs are not readily available or even observable. And so what we need to do is we need to figure out what kind of debt there is, how about the liquidity, what are the credit ratings, and what currency is the debt being traded. So what at first was a super simple example back in your Finance 101 class, it can become way more complicated. Now, if debt is traded, then this is super easy. We have the price, we have the coupon, and we have the time to maturity. Then we can use our regular old time value of money buttons, like I was saying earlier, to compute the yield to maturity on the bond. And the reading emphasizes that even though a firm probably has different bond issues out there, we're going to pick the one that has the longest maturity, probably because that's the most relevant and it probably has the highest yield to maturity. If we're evaluating a company that has debt out there that is not traded on any kind of an exchange, then what we have to do is we need to go out and find a bunch of firms that look like that non-traded firm. We need to find tradable debt, bonds that are traded on an exchange, and then find their yield to maturity. And maybe we can just take an average of those, or maybe we can use this matrix pricing model that I'll show you later on in this slide deck. Bank debt, remember, almost all bank debt is amortizing, right? You pay a little bit of interest and you pay a little bit of principal, and over time you retire the initial borrowing amounts. Of course, you pay interest on that over time, but amortizing loans tend to have a lower cost of debt. Leases have lower borrowing costs. I mean, these are relevant for companies like an airline company, or maybe a company that leases out huge farming equipment. And then, of course, we need to consider the currency. And we have an example at the very end here where we'll look at an emerging market debt. All right, let's switch over to equity. How are we gonna estimate the cost of equity? And probably we're going to use this concept of the equity risk premium. We did this back in level 1, and we talk about it pretty regularly in level 2, and clearly we'll move to that in level 3. We're just going to take the difference between an expected equity return. Now, we'll talk about the capital asset pricing model here just a little bit. So that could be the expected return on the entire market, or it could be the expected return on an industry or a sector or almost anything else. But it's an expected equity return minus the risk-free rate of interest, and it's called a premium because it is the return that you earn from taking risk, right? If you invest in a risk-free security, you take no risk. If you invest in an equity security, you take some extra risk, so the difference between those two is an equity risk premium. So how are we going to do this to compute the company's required return on equity, or its cost of equity? Well, we're going to take that expected risk-free rate of return, and we're going to add an equity risk premium plus an idiosyncratic risk premium. And that's that really fancy word to describe the risk associated with the individual company. We can do this two ways. We can do it with an historical approach, that's called the ex post method, or we can use a forward-looking approach, that's called an ex ante approach. You probably heard me say in previous recordings that in my investments class, I take my students to Yahoo Finance and we type in a ticker symbol and we download into Excel a series of historical, usually monthly prices over 1 year or 2 years or 3 years for individual companies. All right, so what do? If you do this, you can get stock prices for, tons and tons of years. Download that into an Excel spreadsheet, convert those to monthly returns, and then you can do all sorts of fun stuff with that, namely estimate the beta, talk about estimating correlation coefficient. You can even use the Harry Markowitz efficient frontier and the solver function. So the historical approach is readily available, and you guys probably have way better access to it than I do. Although we do have the Bloomberg terminals in our trading lab. So what does this tell us? Reliable, long-term equity return data is available. What do we need to do? We need to ask ourselves the question, do we believe that history is going to repeat itself? Over the long term, we know that it does. The problem is, what's the timing of this? So how are we going to determine what that historical equity risk premium is going to be? Well, we need to pick an equity index. Do we want to pick the S&P 500? Do we want to pick the Wilshire 5000? Do we want to pick Jim's equity index? So that's a critical assumption. And lots of researchers have discussed this over the years, lots of academics. In fact, when I was in graduate school, our professors made us read a paper called Roll's Critique. And that was what I'm talking about right there. How about time period? When I do this with my students, we typically go back over a 3-year period for our Harry Markowitz model, but there's no reason you can't go back 5 years. And if you guys have access to better data sets than I do, then you can go back for longer time periods. The problem is that when you go back over long time periods, you're going to bring in stock prices and index values and returns that may not be reflective of the current market. Right? Do you want to have the stock market crash of 1929? Do you want that to be influencing your decision making and your estimation of an equity risk premium today? I mean, you might, but you might not. Then you have to figure out what kind of a mean. At the very bottom of the Excel spreadsheet, I have my students just take an average. So that's the arithmetic average. And we know from level 1 that has, lots of interesting problems. I mean, it's easy, it's simple, everybody understands what an average is. But it really doesn't give us a determination of the change in the value of a portfolio over time. So what the reading suggests is that if you're doing one period, then go ahead and use the arithmetic average. But if you're using multiple time periods, then you're better off computing the geometric average. And then what do you use as a risk-free rate? Oh boy, this is a tough one. So if we go back 3 years in monthly returns, so then it probably makes sense to go ahead and find out what is that yield to maturity on a 3-year Treasury note. That reflects everything going forward 3 years and going back 3 years. You can see how this might not match. So selection of the risk-free rate is potentially a big deal. But I got to point out to you that here in the United States, the Treasury yields over the last, pick a number of years, couple of decades, have always been, 2%, 3%, 1%, 2%. So the difference in there is not that dramatic. Now, of course, in 2022, we have massive inflation, interest rates are rising. So the selection of this risk-free rate sub or proxy is probably more critical in determining that equity risk premium. Yeah, there we go. Can vary over time, survivorship bias. That makes perfect sense. All right, how about a forward-looking approach? Well, what we can do is we can just go out and ask a bunch of people. And I know that Barron's used to do this. I don't read Barron's anymore, but they used to do this. I know either Forbes magazine or Fortune magazine used to do this, and you guys probably know this better than I do. You can do a quick search, and I did this morning when I woke up. Just what do analysts think the returns in the stock market are going to be over the next year. And what comes up in the search is you have all these investment banking firms that have all these smart analysts. Maybe one or two of you are those smart analysts that I just read this morning. And they give you their estimate of what the equity markets are going to do over the next year. I will say this. I did read one that was back in March of 2022, and their estimate for annual inflation was 2.1%. So I scratched my head and I said, okay, that's not anywhere near what inflation was in 2022. Then we can use the Myron-Gordon growth model. We'll do that here in just a little bit. Or we can use some macroeconomic modeling, in which, remember, when we did all sorts of things like time series and in our quantitative methods, we talked about factor models. And we can identify certain factors like inflation or energy prices to use those to try to estimate what that equity risk premium is going to be. So let's go ahead and start with the Myron-Gordon growth model. Of course, Myron-Gordon developed this model as a shortcut to compute the price of a share of stock back in the 1950s. And it really gave us a great contribution. This is really nothing more than the price of a financial security is the present value of a growing perpetuity. And that G there is a constant growth rate. So a lot of times this is called the constant growth model or the dividend discount model. So in its original form, there it is in the white in the blue box. And then if you rearrange the Myron-Gordon growth model, you get you solve for the required return on common stock or the cost of common stock. Now, I'm a little bit curious that in this reading, in this section, the notation uses V sub 0 as the value of the stock today. Later on in the reading, it uses P sub 0. So I don't want you to get confused. P sub 0 and V sub 0, they mean the same thing. And so look in the yellow over there. What are we saying? That the required return on equity or the cost of equity is a function of dividends over price, dividends over value. That's dividend yield plus the growth rate. So think about that as kind of like a capital gain. So this is at the individual level. And then what the reading does is it goes to great lengths in the next couple of paragraphs to say something like, look, we can use this Myron-Gordon growth model to estimate the price or the required return on a share of common stock. But what we then can do is we can use that and extend it to the entire market. And that's what we're doing down there at the bottom. The forward-looking equity risk premium can be estimated as, and notice what I have in those brackets. I have the expectations of dividends over value. So this is the entire market value. So that D1 are all the dividends. Let's just suppose we pick the S&P 500 index as a proxy. So these are the expected dividends for all the S&P 500 firms 1 year from today divided by their value. So that's kind of an expected dividend yield. What we're going to do then is we're going to add the expectations of earnings growth. So there's a segue in the reading that goes from the growth rate up in the top blue box. That G up there, that's clearly the growth rate in dividends. And of course, the growth rate in dividends is a function of the growth rate in earnings. So we do a little bit of interpolating and say, okay, let's say in the bottom here, we're taking that expected growth rate in earnings. So what's the equity risk premium? It's the expected dividend yields plus expected growth in earnings, and then we subtract out the risk-free rate to get an equity risk premium. Now, one of the more popular models is this Grinold-Kroner model, in which what I did in the previous slide, here, let me go back here. What I was saying down at the bottom there is more formalized into dividend yields and expected capital gains. So go back to what you learned in level 1 about the promise that the executives made when they issue shares of stock, right? Shareholders provide capital to the executives, and the executives say, look, I'm going to take your capital. I'm going to be a super steward of your capital, and I'm going to invest in all of these positive net present value projects. And if I'm successful, I'm going to pay you a dividend. So there's that first part there, dividend yield, dividend over price. And then over time, you may be able to go to the New York Stock Exchange and buy low and sell high. All right, so there's the two components of this promise that the executives make to the shareholders. I'll pay you a dividend and you might generate a capital gain. But look, you're only going to be able to do that if the executives show their brilliance by investing in wealth increasing projects so that stock prices rise over time. Now, of course, in this Grinold-Kroner model, we're aggregating dividend yields and capital gains to the entire market. And then we're going to subtract out that expected risk-free rate of return to get an equity risk premium. So think about what's inside the brackets as essentially a return on the market portfolio, a return on the S&P 500. What's it composed of? It's composed of dividends and capital gains. Yeah, a couple of things here about these models. These are really cool models, by the way, but they do have some problems. And one of the problem is that the dividend discount model assumes that the PE ratio is constant no matter what happens to dividends or growth and prices. And that's a pretty big limitation. However, you can get past that because it gives us a pretty good foundation to try to estimate that equity risk premium in this forward-based model. Now, all of these models, when we make an estimate, we're going to have an error, right? Whenever you predict something, you're going to predict it with some degree of a mistake. We call that degrees of errors in forecasting back in our quantitative method days. And then, boy, we spend a little bit of time in level 1, a little bit of time in level 2, but we're going to spend lots of time in level 3 on behavioral biases. There are cognitive errors, mistakes of the brain, and emotional biases, mistakes of the heart that either are overcaptured or undercaptured in these macroeconomic models, in particular the macroeconomic factor models. Now, look in the blue there. That's exactly what I did in yellow from that previous slide. And so what we're going to do is we can estimate the required return on equity using that dividend growth model. But we have to have dividends, we have to have price, and we have to have some estimate of a future growth rate. And remember, the way this Myron-Gordon growth model works is that when the executives say something like, hey, how about if I pay you a dividend of $1 next year? And the shareholders get together and they say, hey, you know what, that's a good starting point. But aren't you brilliant? Didn't you just tell us you're investing in lots of positive net present value projects? Well, when your brilliance materializes in the future, then we want to share in that. So that $1 dividend is okay to start with, but we want a growth rate. And that's what that G is. It's that G is a sharing in future profitability. That's why in that Grinold model earlier, it was easy to make the link between dividend growth rates to market expectations of changes in earnings growth. Now, what the reading does emphasize is the problems with this Myron-Gordon growth model, that these are for dividend-paying firms only, and that is true. But remember, when we talk about equity valuation in some other readings, it's super easy just to substitute free cash flows in that numerator. But that's not a conversation for today. But that's a conversation for you to put in the back of your brain, that we can still use this Myron-Gordon growth model for companies that don't pay a dividend, and we can just put free cash flows in the numerator there. All right, how about a bond yield plus something? All right, so what we're going to do is we're just going to say the required return on equity is equal to the required return on debt, or the cost of debt, plus some risk premium. The problem is trying to figure out what those risk premiums are. We're going to do that in an example at the end of this slide deck, and you'll see how complex it can become. Yeah, this is what I was saying. Premium is difficult to estimate, right? Securities must be traded, different features. Maybe there's a call feature in there. All right, how about risk-based models? So let's go ahead and look at the capital asset pricing model. We did this back in level 1. You did it in your undergraduate days. You may have done it in your graduate school days. So capital asset pricing model was developed in 1964 by, several academic researchers, one of which, who generally gets claim for this, is William Sharpe. And William Sharpe simply told us that the required return on a company's share of stock, or alternatively, the cost of equity for a company, begins with the risk-free rate of interest, just like it did back somewhere embedded in here. There's a risk-free rate of interest in that cost of debt for a company. What we're going to say is that, all right, William Sharpe said we're starting with that risk-free rate of interest, and then we're going to add something to it. And that's something that we're adding to it is, of course, the equity risk premium, but the equity risk premium is going to be weighted by the beta of the company's stock. Remember, beta in general has a range of between 0 and 2, although that's not statistically true. But in general, people think of it, and that's okay, I think, for you guys to think of between 0 and 2. The average beta is 1.0, and it is a measure of sensitivity. In fact, you can compute beta using regression analysis, so it is a slope. It is a measure of sensitivity. High beta stocks, those that have, let's say, 1.75 or 1.9, those are what I call overreactions. Stocks that have betas that are low, 0.3 and 0.5, those are stocks that are called underreactions. And so let me just give you a quick example. Let's suppose that we know today, we observe that the S&P 500 returns 20% today. Some crazy example, right? Well, what does our individual stock do? What does the required return on our stock do? Well, if we have a high beta stock, our stock is going to increase by 20% or 30%, depending on the beta. If we have a low beta stock, our stock is only going to increase by 5 or 10%. So you get the sense of the capital asset pricing model is so cool. It's, of course, a Nobel Prize winning piece of work, but it captures the systematic risk factor, the sensitivity factor to changes in the entire market. Now look at that first embedded bullet point there. Yeah, beta, use the market model, right? Replaces the market and company expected returns with historical returns. I'm going to say this here. This puts a lot of pressure on beta, a tremendous amount of pressure on beta to capture all of this stuff. Now you can use the capital asset pricing model even when the company is not publicly traded, because you can do exactly what we just did a few slides ago. You can go out and find a couple of publicly traded companies that have similar size, similar assets, similar leverage, similar product lines, similar board of directors, similar, find out what their beta is, and then you can just substitute that beta, and you'll probably do a weighted average or however it works to estimate the equity risk premium for a non-public company. Now, remember what I was saying, that in 1964, William Sharpe and others came up with this capital asset pricing model, and they put a lot of pressure on beta. So a handful of years later, Eugene Fama and Ken French recognized all of the pressure on beta, and they said, you know what, there's probably some other stuff out there that beta doesn't really capture. It's like going out in your front yard and taking a picture of the horizon. Take a picture of the horizon and you can see, maybe the moon's out there, maybe the sun's out there, maybe some clouds. And so those are kind of obvious things, and beta can capture that. But what beta can't capture is the wind direction and the barometer. I'm making this stuff up because I'm not a scientist. And it can't capture the photosynthesis in all the trees out there. And so Fama and French said, let's go ahead and let's become more granular. Let's find some other factors. And what Fama and French found is that there's a size premium, right? Small firms, they have greater returns than large firms. And there's a value premium. Value firms have greater returns than growth firms. So there's the Fama-French model that should be familiar from level 1. And notice now, instead of, let me go back here real quick, we just have one beta in the capital asset pricing model. Now we have 3, so there are 3 subscripts. So that beta 1 and the equity risk premium here in the Fama-French model, that's the same thing as the capital asset pricing model, but what we're going to do is we're going to add a couple of premiums. We're going to add a size premium and a value premium. Now, of course, you should be wagging your finger at me, Jim. You should say, you know what, Jim, what you just said is not exactly statistically accurate. And I agree with that, that the beta that you get here using the capital asset pricing model is not going to be equal to B1 because of things like correlation coefficients and maybe some other variables there. But what it does, Fama-French uses the capital asset pricing model and then adds some extra premiums to be more explicit. And then a handful of years later, Fama and French extended this to 5 factors. A profitability factor, RMW. So what we know is that firms that have greater sustainability and profit have greater returns than firms that have less sustainability and profit. And there are probably different ways to measure the quality of those earnings, but Fama and French just called it a profitability factor. And then CMA is an investment factor. Those firms that have stable investment capital budgeting models earn greater returns than those that don't. So think about this. You might think that on the next slide, I'm going to say, oh, Eugene Fama, Fama-French came up with the 7 or the 8 factor model. And you can add, of course, any different factors there. But the point is that this 5 factor model here is probably pretty sufficient to use some quantitative methods. Of course, we're going to use regression analysis to estimate the B1 all the way through B5. We need to collect all of this data here. So we've got this problem. Are we using historical returns or forecasted returns? But nevertheless, this is a really cool model. And notice we have a warning sign down at the bottom that we need to be concerned about. And this is just what I've been talking about, the difference between the 3-factor model and the original 1-factor capital asset pricing model. Now, I mentioned this just a little bit here. How about for private companies? Data on security returns is probably unavailable. They're probably smaller. Private companies probably don't disclose lots of information. They're probably less liquid. So what we need to do then is we're probably going to take a look at all the stuff that we just did, but we're going to probably add an industry risk premium, a specific company risk premium, maybe a size premium. I have a great example here at the end to show you this example. So let's go ahead and expand the capital asset pricing model by just adding a size premium, an industry risk premium, and a specific company risk premium. And that makes perfect sense here. So we're starting with CAPM, and then we're just going to add a bunch of extra stuff. And that extra stuff is the granularity that I was talking about in relation to what did our mother charge us in that very first silly, simple example? I think it was 2%, right? Well, where did our mother get that 2%? Well, she got it from here, right? She added a size premium and an industry premium and a specific company risk premium. I'm not sure how that relates to mothers and their love for their children, but you get the sense here that you can add some components that are relevant and they are specific to that individual issue. That makes sense, doesn't it? All right, so what are we going to do? Estimate an industry beta, right? Use the capital asset pricing model with that beta, determine if, and look at step 3, that's important, if additional risk premiums. Let me go back here. There might not be a size premium. There might not be a specific company risk premium, which means that some of those premiums might be 0. So don't be upset on the exam if you have, if the institute gives you 0 for one of these. That just means that it doesn't exist. And then notice step 4, if necessary, find some other stuff out there that is relevant and then add it to it. Now here's the build-up approach. All we're going to do is, let me go back here real quick. In this expanded CAPM, we're going to use the beta, and that's probably that beta of the industry times the equity risk premium. Here in the build-up approach, we're not going to do that at all. We're going to ignore all of the betas, and all we're going to do is just build up approach. And so notice under the blue box, blue box, the equity risk premium, is not adjusted for beta. So what we're just saying is that, hey, maybe we don't have access to all that data to estimate the betas, or even still, maybe we just think all those betas are 1. So that's a really key part of the question stem where the Institute could say, hey, all betas are 1, so then you don't have to worry about adjusting each of these factors to the beta. And then, of course, there's emerging markets data. We'll do that in an example here. Now, what do we do if we have to consider individual countries and individual default risk? Well, what we're going to do is we're going to estimate this equity risk premium by saying, okay, what's the equity risk premium for a developed market? And then there's a plus sign, right, in the blue box. We're going to add a country risk premium times some scalar that's going to be reflective of the exposure of that particular portfolio to the local country. So we'll call that lambda. Country risk premium, this is exactly what you get in an international finance class. All we're going to do is take the yield spread, that sovereign yield spread, and we're going to multiply by the ratio of standard deviation. So we take the standard deviation of equity, standard deviation of the bonds, and that gives us a ratio. So think about that. That's kind of like, boy, don't tell your other finance professors that I said that. After the multiplication sign, this is almost like, it's kind of like a beta, right? So if the equity is, let's say it's 15, standard deviation is 15, and the bond standard deviation is 10, well, we're going to multiply by 1.5. Now that's not a beta. I'm not telling you that it's a beta, but it's kind of like a beta. Now, of course, beta, you have to do some other standardization mathematics, but I think it's okay if you interpret it as a measure of sensitivity. Forget about beta, measure of sensitivity. All right, you might remember we talked about this concept of the global capital asset pricing model. This is part of what the reading calls extended capital asset pricing models. So in the global CAPM, there are no major risk differences across countries. So what does that say? United States, Germany, Canada, no major risk differences. So what we can do is we can have a single factor. That's important in the global capital asset pricing model. Yeah, what are the problems with this? Yeah, there's probably low correlation between and among markets, and so that might find some kind of a beta that doesn't look like we want it to be. Remember I said to you that most people think of beta as between 0 and 2. Well, when I wrote my dissertation, I computed the beta of about, 2,000 different companies. And the overwhelming majority of them were between like 0.3 and 1.8. But I had some that exceeded 2. I had one that was like a 3.3 or a 3.2. I forget the exact number. Remember, I wrote my dissertation thousands of years ago. And then I had 5 or 6 negative betas. And so that means that there are negative correlation coefficients. Now, of course, we also have to worry about reliability of financial data. It's one thing to go to Yahoo Finance or to Bloomberg like we can here, but it's another thing to go into another country. We don't know if that financial data is complete, if it's accurate, and if it's been being reported in a timely manner. Now, the international capital asset pricing model, what we believe is that there are probably some risk differences and they might be major. So we're going to regress those returns so that we can come up with our own individual sensitivities. So here's what a model like this might look like. Expected return, or the cost of equity over on the left-hand side. And so what are we doing? We're going to start with a risk-free rate of interest like we always do. And then we have 2 sensitivities. So sensitivity to the global index and sensitivity to the foreign currency index, which is what we were just doing back in that previous slide. So notice we have, in parentheses, we still have a market portfolio, but now over on the far right, we still have a market portfolio, but now it's a market portfolio of currency. That's a currency index. All right, let's go ahead and take an example where we're going to illustrate how we can estimate the cost of debt and the cost of equity. All right, you ready for this? So here we have an analyst, estimate cost of debt and equity for DMC. And so here's some notes about this company DMC. There's some business model, industry. So we're in the auto, publicly traded small company, upward trend. Here's our capital structure, 70% common stock, 15% preferred stock, 15% debt. There's some interesting items over there on the far right about capital type formation. This is all in Exhibit 1. But let's go ahead and read the paragraph up there. High sales, profits recently, but their flagship vehicle, Icarus, declined due to new European emissions. There's an externality with the climate people. This put the company in a liquidity crisis, so they're going to raise cash by issuing redeemable preferred shares, which came at a high cost. So now what we're going to do is DMC is going to issue unsecured debt to retire that high preferred cost. All right, so the question then becomes, how do we do all this stuff? What's the LOS? Estimate the cost of debt, estimate the cost of preferred stock, estimate the cost of common stock. So that's what we're going to do here. So let's go ahead and gather information on 4 different corporate bonds with similar BBB ratings as ours shown. So here we have coupon rates, we have years to maturity, and we have current price. What we can do is we can go ahead and, we can go ahead here in the bottom. I'm going to skip to the solution. Here's our cost of debt. What we're going to do is we're going to take bond A, B, C, and D. We're going to get out our financial calculator and we're going to solve for the yield to maturity. So there you have the yield to maturity over there on the far right, bottom far right. So 5.9, 5.2, 5.0, 5.8. So there's the yield to maturity on each of those bonds. Let me go back here real quickly. Notice that 2 of those bonds mature in 8 years, 2 of those bonds mature in 4 years. So how are we going to estimate that cost of debt? Well, remember early on I said in this slide deck that we're going to do some kind of pricing according to the matrix or matrix pricing? Well, let's go ahead and I'll show you how to do that now. And it's relatively simple. So the first step is to compute the average yield to maturity for the 4 years and the average yield to maturity on the 8 years. So we'll just take those 2, divide by 2, and get 5,163 and 5,905. What we're going to do then is we are going to linearly interpolate to estimate the averages for 5, 6, and 7 years because, let me go back here. Where did I see that? What we're going to do is we are going to, here, look on the far right column, 7 years remaining to maturity. So we are going to issue this unsecured debt as a 7-year bond. All right. So what we need to do is this matrix pricing and this interpolation. All right. So what we're going to do is we're going to take the difference between our 5,905 and our 5,163. Those were the 2 averages, 4-year average and 8-year average. And we get, what is that number there? 0.742%. Let's see. The difference between the years of those known yields is, remember we had the 8 and the 4. So we're going to chop that 0.742 by 4 to get 0.1855%. Then we're going to do this matrix pricing here. So estimated yield to maturity in year 5, we're going to take our 4-year average of 5,163 and add the 0.1855, and that gets us to 5,3485. That was just for our 5-year bond. Now we need to swing this back. This is the matrix pricing. So then we're going to add 1855 to that. And then once again, add 1855 to that. So there's that third line. The average yield to maturity in year 7, because we're issuing a 7-year bond, is going to be 5.7195%. So there's the yield to maturity of 5.72%. Feel free to take a deep breath and say, "Great day in the morning, Jim." There's a Fred Sanford quote for those of you who have ever watched Sanford and Son. You should be thinking, wow, this is a long way to come up with the yield to the maturity on the bond. Wouldn't it have been just as easy to just either A, give it to us, or B, just make us calculate? But the Institute, every once in a while, they want to provide you with a learning opportunity to do something cool. And I believe that's why they go through this entire process here. That slide, well, here, we got to go back here. Oh, we need to go all the way back here, right? That's where it starts. We get the question stem, and then we had to get out our financial calculator and do all this stuff. So this is a pretty good exercise in estimating the cost of debt. The authors have gone to great lengths to show you how to use this matrix pricing. So I would probably be prepared to do this. All right, let's move on to computing the cost of preferred equity. This will be really simple. Let's go back to, where are we here? Yep, let's go back to the far bottom right column and row. Frequently trading, current price is $8.90. The dividend rate is 8%. So where am I going back here? So all we're going to do is take that 8%. That gives us a dividend of 70. Divide that by 890. And notice what we did there. We used the Myron-Gordon growth model, but growth rate is 0 for preferred shares. So we'll just add 0. So there's our cost of preferred stock, 7.87%. Now remember, we're going to issue a bond that has a yield to maturity of 5.72, and we're going to retire that 7.87%. Now let's go back and look at this Exhibit 3. We're using the Fama-French 5-factor model to estimate the DMC's equity cost by regressing these. All right, so here's look in that far right column. There are the betas from that regression analysis. And there are the risk premiums that were collected based on all of this analysis. Maybe this was a top-down analysis. So let's go ahead and let's compute the current cost of common equity. To estimate the current cost of common equity, we'll go ahead and use that Fama-French 5-factor model. We'll start with a 2% risk-free rate of interest that was given to us somewhere. I don't think I read that. Yeah, here it is in that third row. 20-year government benchmark is 2%. And then all we're going to do is we're going to take those risk premiums in the third column and multiply them by the beta in the fourth column, and that's what we've done in this slide. And so if you do all that math, you get 9.6%. Now, it's interesting that even though we're calling this, this reading, let's talk about the weighted average cost of capital, the reading doesn't go ahead and compute the weighted average cost of capital, but we've done this for you here. So let me just remind you what we've done. We are issuing a bond that has a yield to maturity of 5.72%. We're using the proceeds to retire preferred stock issue, which was costing 7.87%. Which means that we can easily compute the weighted average cost of capital. Now, remember in that slide earlier, the debt proportion was 15, the preferred equity portion was 15. So now we issue the bond and we retire the preferred. That means that the weight in debt is now 30%. So we'll take 30% times that 5.72, and then we'll add the 70% of the equity times the 9.6. So there's the weighted average cost of capital for this firm. Now remember, this is after the change in capital structure. Now also note that I ignored taxes there, but we'll consider taxes in the next example. Now, remember what I was saying earlier, that the Institute every once in a while takes you through what I think is a curious example. And I thought the matrix pricing was a good example to get you thinking along the same lines that the Institute does. Well, the reading ends with what I'm going to refer to as a super curious example. So what we've done is we've come up with a similar example, but we're going to take this one step further. What the reading does is it gives you lots and lots of open ends. But what we try to do in the last couple of slides is to close those ends into a nice little bow. So I encourage you to compare our example here to the example at the very end of the reading. You'll see some similarities, but then you'll see we go one step further to go ahead and estimate the weighted average cost of capital. All right, so here we're thinking about acquiring a company. This company is called Marigold. So what we want to do is we want to evaluate Marigold's weighted average cost of capital. So not only are we going to evaluate it in these next couple of slides, we're also going to estimate it. All right, so here's a bunch of stuff. Common size balance sheet. Here's some other information that's important. There's debt, there's assets, there's some operating income, there's a tax rate, and there's an interest expense. Some other notes here: spare parts sales, 6 customers, 60% of revenues, right? Family-owned business. So what we're going to do is we're going to internally develop a synthetic bond yield schedule to estimate the company's cost of debt. And here is this synthetic credit rating schedule. All right, so what we've done is we've decided that here are the bond ratings over on the left-hand side, and then the credit spreads that will be reflective of an interest coverage ratio. Notice we have some ratios there in the third column, and debt equity ratios in that fourth column. All right, so let's go ahead and estimate the yield to maturity on the bond, or the cost of debt. So in order to estimate that yield to maturity, let's go back and take a look at this interest coverage ratio. What we're going to do is take our operating income, which was given to us as EBITDA, divided by interest expense. So there's the 9.6 divided by the 1.3, and I'll go back here. There's 9.6, there's 1.3, all right? So there's our interest coverage ratio of 7.38. Our debt equity ratio, we're going to take 20.4 divided by total equity. So let's go back here. There's the 20.4 in debt. There are the total assets. So what's 110 minus 20.4? What is that? 89.6. Did I do that right? Nevertheless, there's a debt equity ratio of 0.228. So let's go back and find 738 and 228 in our matrix. So there we go. Look in the third row. There's a single A rated bond. And notice our interest coverage ratio and our debt equity ratio fall in there. So our credit spread is going to be 1.5%. Notice down there on the bottom right that our 10-year benchmark government bond is yielding 6%. So yield to maturity on the bond, we'll start with that 6%. We'll add the appropriate credit spread of 1.5% to get 7.5. Now let's go ahead and estimate the cost of equity using the build-up approach. So all we're going to do is go back here. Notice Jackie assigns the following risk premiums. There they are. And so let's go ahead and just add those, 6 and 4 and 5 and 1 and 3 and 2. We get 21. So our yield to maturity on the bond, our before tax cost of debt is 7.5%. Our cost of equity is 21%. Well, let's go back and take a look at our capital structure. And somewhere in the question stem, it tells us that the target capital structure is equal to our current capital structure. So there we go. 20.4 is our total debt divided by total assets. There's the weight in debt times the 7.5%. And now we're going to multiply by 1 minus the tax rate. Somewhere in this matrix, there's a tax rate. There you go, marginal tax rate, 20%. And then 89.6 divided by 110 times. So there we go. There's our weighted average cost of capital of 18.2%. So what we've done in this slide deck is we've kind of summarized this problem. The reading, I say it's curious, the reading just stops right here at the end and says, okay, here are the ways to evaluate it. So we evaluated it based on all this stuff here, and now we computed it. And that takes us through these learning outcome statements. I can't help but tell you that I was a little disappointed that there was only one vignette at the end of this reading, one 5-question vignette. And so it seems to me like we've done a lot more stuff than just 5 questions. So I'm going to go ahead and say each of these LOSs is super important, but estimate cost of debt, estimate cost of equity, those are probably the 2 most important. And then summarize them, and let me go back here. I usually don't do this, but I'm going to summarize them with this example and then this example right there. So thank you for watching and good luck studying.